Good afternoon, everybody. Uneducated economist here. I was reading a really good article coming out of Bloomberg earlier talking about, let's see, what was the title of it? The bedrock of ultra low yields may be at risk. Anyway, it was a very interesting article talking about how the monetary policy has pretty much run its course and how the monetary policy will be switching more over to fiscal policy to be the main driver of the economy. So for like the last 12 years, we've had credit expansion as the main driver of the economy. People taking out loans to buy houses, cars, go on vacation with their credit cards, stuff like that. But we've reached like a debt saturation where people, even if they wanted to, can't really afford to take out any more credit. Okay? They're filled with student loan debts and their credit cards and their house loans. They just can't take on any more debt. So the monetary policy has essentially run its course, which means that we need to step into fiscal policy to be the main stimulator of the economy, the main driver. Now, that means that government will have like the spending bills, government projects, building things, construction jobs, tax breaks. This is the fiscal policy that will be the driver of the economy. Here's the thing. If the Federal Reserve is not stepping in with their monetary policy, well, that means that the Treasury will be seeking out investors for their treasuries in order to, find the spending that they need to do. You can't just like spend money without having a buyer of your treasuries. You're borrowing money to spend, and you have to do that through the treasury markets. And if the Federal Reserve isn't stepping in with their monetary policy, then the interest rates need to rise in order to attract an investor. And this is what they mean by the ultra low yields. The bedrock of ultra low yields may be at risk as this switch from monetary policy to fiscal policy. Now, this takes place over the course of like years. Okay, it doesn't happen in a single day. So this is like the future of monetary policy or economic stimulus. As far as how the driver of the economy is going to function, it's going to be more in the hands of the government and their fiscal policies. Very interesting thinking. And with the rising of interest rates, it's going to make bond investors not as happy as they have been for the last couple of years, as interest rates have done nothing but go down, driving the bond prices up. Well, for the last 12 years, and essentially since the early 80s, nobody really has lived in an environment of continual rising interest rates. Everybody's been in an environment where the interest rates drop. And so to try and like envision what the economy would run like in a continuing rising interest rate environment is very difficult for most economists and most investors because they just never lived that type of condition. Very interesting stuff. And I like the very last, I can't remember exactly what the quote says, but the very last line in this article, they quoted one of the, I guess, who was this guy? I can't remember his name, but he's from the Standard & Poor's. And he said that markets have grown complacent to the idea of rising interest rates. It doesn't go exactly like that, but it's something very similar. And that's the case. Nobody believes that interest rates can rise. They think that, pretty much the government would crash under the weight of its own debt if the interest rates were to rise. They wouldn't be able to afford it. So, very interesting article. A lot that we can talk about on that one. Uneducated economist. You guys let me know.